Thank you for joining us today. My name is Chuck Else, and I'm one of the principals here at Osborne Partners. And I'm joined today by my colleague Tom Pirro, a wealth counselor and one of our certified financial planners, to talk about concentrated stock positions and option strategies. But first, a quick introduction of our firm. Osborne Partners is one of the oldest wealth management firms on the West Coast, providing sophisticated investment management and active financial planning services. Founded in San Francisco in 1937 with a secondary office in Silicon Valley, we manage approximately $2 billion in assets for clients ranging in wealth from 1 million to 100 million or more. We also work with many third and fourth generations of families that have been with our firm going back all the way to the 1950s. We are a multi-asset class manager, meaning we typically allocate our client portfolios across 7 different asset classes. We are also style agnostic, which means we will invest wherever we can find the best risk reward opportunities at any given time across all asset classes. Our investment team of CFA charter holders averages over 20 years of professional investment management experience each. In addition, our team of certified financial planner professionals provide comprehensive and active financial planning services to our clients. This could include investment planning, goal planning, planning for life events, and we also provide some very powerful financial tools to help our clients optimize their overall financial lives. Now, many clients that we work with have accumulated concentrated stock positions over their careers. This can be due to a major liquidity event, such as an IPO, a gradual accumulation of vested stock options, or perhaps the purchase and long-term holding of a growth stock. Tom, what's the most important thing for investors to know about having a concentrated stock position?
Thanks, Chuck. I think Warren Buffett put it best when he said, concentration builds wealth and diversification preserves it. And while most owners of concentrated positions have experienced growth over many years, there is significant risk in owning a concentrated position. Now, it's unlikely that a company will become the next Enron or WorldCom. The risk I encourage concentrated stockholders to think about is that many large capitalization companies won't go bankrupt or see their value of their holdings go down to zero. But there is a significant risk the company could have performance similar to, say, a Cisco or a Microsoft from 2000 to 2015, where those companies, after many years of rapid growth, experienced almost no stock appreciation for those 15 years. And for most client financial plans to work, they need the growth.
That's a great example, Tom. What are some other things that investors with a concentrated stock position need to recognize?
Yeah. Something clients should realize about their holdings is that they need to make a number of complex decisions. So when to sell a stock and minimizing taxes are obvious things to think about. But clients often forget about the complexities of incentive stock options. And deferring to take action on those incentive stock options can lead to larger tax liabilities and increased risk in the future. And so while a thoughtful strategy can often lead to more favorable outcomes. So really the takeaway here is to start the planning process early.
That makes a lot of sense. Maybe if you could discuss a little bit at a high level, the approach and the process that we use here at Osborne Partners regarding concentrated stock positions.
Sure. I'd say there's really 2 defining characteristics of our diversification process. First of which is we're data and evidence driven. And for concentrated stockholders who quite often can have emotional connections to their stock, this is critical. And then secondly, we'll use our proprietary research and analysis to help drive the diversification process. And if you're to think about ultimately how we diversify concentrated stock over time, there's really 2 main drivers. First of which is we'll put a plan in place with the goal of diversifying a concentrated position over, say, 3 to 5 years, and then investing the proceeds into a more diversified portfolio. However, the speed at which we diversify over time is also driven by our proprietary analysis of the stock. So put differently, when we think the stock is overvalued and has a higher than average likelihood of increasing, we'll diversify less at that time. And then on the flip side, if we think the stock is overvalued in the short term, we'll sell more. And I call this diversifying in relation to the market.
That process makes a lot of sense. What are some other considerations that should be taken into account as part of Osborne's diversification approach?
Yeah, happy to share some other considerations. And I think really the short answer to that question is individual client and specific goals. So this particular slide illustrates just a handful of the goals we commonly hear from clients. And for purposes of illustration, I'll focus on the first goal, which we call locking in your lifestyle. And really the simplest way to think about locking in your lifestyle is when you have enough assets invested in a diversified portfolio where you can safely project that the growth and income from that portfolio can support your lifestyle and you no longer have to work if you don't want to. And so as this relates to our diversification process, we generally diversify more initially with the objective of creating a portfolio that's large enough to support a client's lifestyle. And then after the goal of locking in a client's lifestyle is met, then we can focus more on long-term optimization of the stock.
Are there other considerations or tactics that investors should consider?
Yeah, I'd say the main really outstanding investment tactic that we haven't yet covered is our strategy utilizing protective collars. Now, if you aren't familiar with protective collars, the basic objective is to reduce risk and volatility with a concentrated position. And the way it works is we'll purchase a derivative called a put option, which will protect the value of a concentrated position from dropping below a defined price. And we'll fund the purchase of that put by selling a derivative called a call option. Now, the catch with a call option is that caps gains of the stock above a defined level. So in this particular illustration, you can see the purchase of a put option and also the sale of a call option would protect the value of a stock from falling below $25 and the gains being capped at 75. Now, this is obviously a very basic example, and there are many more considerations when you put in a protective collar, such as the conditions as to when is optimal to implement a protective collar, and the data and evidence that tell us a protective collar could potentially be counterproductive. We don't have time to go to them all today, so look for us to cover that and other advanced strategies in the follow-up webinar.
Okay, thanks, Tom. Well, I know that one of the things that's always top of mind for investors is taxes. So what tax considerations should investors be thinking about, and what particular vehicles does Osborne evaluate as it pertains to taxes?
Yeah. Part of Osborne's wealth management process is develop a multi-year tax strategy for our clients. And this is a subject that's of particular importance to concentrated stockholders. We don't have time to go into every tax strategy we evaluate for clients, but a strategy of particular interest for many concentrated stockholders is what's called a charitable remainder trust. Now, this particular tax vehicle has a number of advantages. The biggest three being, number one, you can defer capital gains even as you sell your concentrated stock. Number two, you can create a lifelong stream of income. And then number three, you can get a significant current tax year deduction for the present value of the stock that will go to the charity. Now, mechanically, the way this works is a client will transfer a portion of their stock into the charitable remainder trust. Once the stock is within the trust, you can immediately or over time sell the stock without realizing any capital gains. Then you can create an income stream to yourself from the trust for as long or as little as you like. And at the end of the term, the remaining assets will go to a charity you designate. And the value of those assets, which will go to a charity, you can write off for your current year taxes. Now, the trust has a number of variables we'll evaluate and help optimize for clients, but for the right person, this can really be a fantastic vehicle.
Thanks, Tom. Well, we certainly covered a lot of material in a short period of time. I hope everyone found this to be useful. If you have an interest in learning more about our concentrated stock diversification process, or would like a complimentary analysis of your own concentrated stock position, please contact us. You can reach us directly at info@osbornepartners.com or call us directly at 415-362-5637. Thanks again, everybody, for your time today and for joining us.